Hello, my dear students. Today we are going to solve board paper 2015. Last class we solved 2014 and we did two problems. One related to hidden goodwill, another related to adjustment of old partners' capital. Now, today's problem, that is for 2015. Here only one problem we are considering here. And that one problem came, and one short question also came, that is for 1 mark, so that we are not considering. Short question, 8 marks question we are considering here, and we will see which type of problem came on that particular year. Generally same type of problem we can see so far. We did so many years board paper question. Here in this year also we will get some similarities, like here again the same way, like capital adjustment, capital account of the partner will be adjusted on the basis of incoming partners basis. So same, like which is coming under miscellaneous head. There is treatment of capital adjustment of old partner on the basis of new partner's capital contribution. Now here in details, let's consider the problem. In these cases we have to consider 4 partner, 3 old partner and 1 new partner, that is incoming partner. This is the problem. Om, Ram and Shanti were partners in a firm sharing profit in the ratio 3:2:1. It does mean 3/6 of Om, 2/6 of Ram, 1/6 of Shanti. And 1st April 2014, their financial position, that is their balance sheet. This is their balance sheet, was as below. This is the asset side and this is the liability side. On asset side, all are common term, known term. Land and building, 3,64,000 amount. It is a fixed asset. Plant and machinery, 2,95,000, another fixed asset. Furniture, 2,33,000, another fixed asset. Bills receivable, it is a current asset. Bills receivable or accounts receivable, also sometime you can say like bills receivable plus debtors together, that is called accounts receivable. When you will do the ratio analysis chapter, that time like sometime this term together will get like accounts receivable. So account receivable means bills receivable plus debtors. So here it is separately provided. Bills receivable, it is a current asset, 38,000. Sundry debtors like customer account here, 90,000. All are good customer, good debtors. Here in this case is bad and as well as doubtful, we cannot see at that moment. Stock in trade, 1,11,000 and bank balance 87,000. Total of the asset side, 12,18,000. Now on the liability side, like the first partner, Om's capital 3,58,000, Ram's capital 3 lakh and Shanti's capital 2,62,000. Total of their capital came 9,20,000. There is one undistributed profit, that is general reserve, 48,000, which you have to distribute to the old partner Om, Ram and Shanti in their old profit sharing ratio. Creditors, 1,60,000, that is outsider liability as well as current liability. Bills payable also same way. BP, that is 90,000. It is also one external liability as well as like current liability, 90,000. Total of the liability side, 12 lakh and 18,000. Now this is their financial picture of the old partner at the time of admission of a new partner. Like a strong financial position, cash balance or cash and bank balance also, it is more balances, sufficient balances is there. Now on that date, Hanuman is a new partner. Hanuman was admitted as a new partner, and the other terms and condition are as below. What are the term and condition? First term, now he will bring rupees 1 lakh for his capital and will get 1/10 share in the profit. So incoming partner will get 1/10 share of profit. Out of total profit, 1/10 will be given first of all to the Hanuman, and remaining 1 minus 1/10, that is 9/10, will be distributed among the old partner. And for that, the incoming partner has to pay 1 lakh rupees as his capital. That is primary condition, first condition. Second condition also there, he will bring necessary cash for his share of goodwill premium. So for super profit purposes, super benefit purposes, the old partner, that is old existing business, they have some like name fame. For that purposes, the incoming partner, that is Hanuman, has to pay some amount extra, that is called goodwill premium for goodwill. And in this cases, the total from goodwill was provided 3 lakhs goodwill. So if he want to pay, that is Hanuman want to pay his share of goodwill, so that time it is coming 3 lakh into 1/10, that is 30,000. 30,000 he has to pay. These two are like actually primary condition and accepted by Hanuman. So here when he paid capital, that time the entry was bank account debit to Hanuman's capital account, and if he paid goodwill money, then we will apply premium method. For that purposes, we know two entries are there. First entry, bank account debit to premium for goodwill, and second entry, that is premium for goodwill account debit to old partner's capital under sacrificing ratio. Next adjustment, like the liability of rupees 18,000 will be created against bills receivable discounted. So here is the BR amount 38,000. So that 38,000, that is a net BR. Before that, one more BR over there, that is 18,000, which was earlier discounted. So when the bill was discounted, and like it will honor that maturity period or due date, like before the due date, it is considered as a contingent type of liability. If like drawee able to pay the amount, then no liability, and if drawee unable to pay, then it will treated as a sure liability. So that is one type of contingent liability. Contingent liability is such type of liability which is not sure liability, which is ultimately depend upon a particular situation. If the situation arises in future, then it can be liability or it cannot be liability. That is totally depend upon the future situation. So therefore, we can say this is one type of contingent liability. Sometimes 1 marks question may can arise here. Give one example of contingent liability. So here we can say the bill receivable discounted and dishonored in future. So that is example of contingent liability. But here now it is converted into the real liability. Now no more it is a contingent liability. So you have to consider this like one unrecorded liability. Liability ultimately increases. So what will be the entry for that? Revaluation account debit to, that is outstanding bill, discounted for outstanding bill. That way. Now next adjustment, the value of stock and furniture will be reduced by 20%. The two asset, one is a fixed asset and another is a current asset. Both the asset value reduced by 20%. So we will calculate respective amount related to this term, like stock and furniture. So here the stock value is there, 1,11,000. Thereupon we will calculate 20%. So 1,11,000 into 20%, 22,200 coming. So we have to decrease that 22,200 from the stock, and furniture 2,33,000. Furniture 2,33,000. Thereupon 20%, it is coming 46,600. So we have to reduce from here, decrease from here 46,600. What will be the entry for that? We know that is revaluation account debit to furniture account 46,600, and the same way stock also reduced. So revaluation account debit to stock 1,11,000, there around 20%, 22,200. So that is that related adjustment. Now another adjustment at the time of admission, the land and building value enhanced by 10%, that is increased by 10%. So on fixed asset value increases. So here it is a land and building value 3,64,000, 10%, it is coming 36,400. So that value increases. The entry will be there, land and building account debit to revaluation. We know the basic rule how to prepare the revaluation ledger. Asset increase, the asset will be debit, decrease, that asset will be credit. The same way the ultimate rule is same for all the time, for all the chapter. When you open the revaluation ledger account, whether it is admission of a partner, whether it is retirement of a partner, whether it is a death of a partner, or whether it is a change in profit sharing ratio, preparation of revaluation ledger is like same rule. We have to adopt same rule. We will apply like increase asset debit, decrease asset credit, and reverse in case of liability. And if credit side is more than the debit side, that is called profit on revaluation. So after preparing, we'll come to know whether profit or loss arises. Now that is the last adjustment, that old partner want to adjust their capital on the basis of new partner capital contribution. So here we can preparing one working note, we can calculate the old partner's capital adjustment. And in these cases, here necessary current account have to open for that. Like here, shortest part we will transfer to their respective current account, whether surplus or deficit, that part have to transfer to the respective current account. Now in these cases, like here, prepare only revaluation and partner's capital account, though here 8 marks is there. In this cases, balance sheet is not being asked. So as per question requirement, we should have to answer, we have to solve. So here only 2 ledger we will prepare. Here balance sheet, that final statement, the scoreboard of the business will not open after admission of a partner. So this is the revaluation ledger. Land building, it was increased, and it was increased by 10%, so it is coming 36,400. Liability for bill receivable discounted, it was given 18,000, so it is increase of liability, revaluation to increase liability for bill discounted. Now 2 asset, one is current asset, another fixed asset, that to value decreases to stock in trade or to stock. Here 20% decreases, so it is coming 22,200. Furniture value also 20% decreases, it is coming 46,600. We can see if we compare this side only 36,400 and this side here 86,800. So debit side this time is greater than the credit side. As per rule of nominal account, if debit size is heavier, then it is coming loss. So this loss on revaluation we have to transfer to the old partner as per the rule. So there are 3 partners in this time. There are 3 partners, Om, Ram and Shanti, and their profit sharing ratio, old profit sharing ratio 3:2:1, 3:2:1. On that ratio here we distributed their loss on revaluation. Om's share on that basis came 25,200. Ram's share came 16,800. Shanti's share came 8,400. Total of the loss 50,400. So both the side tell it. Now that is partner's capital account. Partner's capital account, we know the rule. First of all, like here we are using columnar method for all 3 partner. Due to lack of space, we cannot draw together 4 columns, 4 this side, 4 this side, 4. So here we are using columnar method for all 3 partner, and like separate column for incoming partner, that is Hanuman Capital. Hanuman Capital is a new partner, so that is less treatment in case of new partner. Only for his capital contribution purposes, 1 entry will be there, bank on debit to Hanuman Capital. So buy bank 1 lakh, and that will be to balance CD. I can buy balance PD. So that is very simple way. Separately we can draw, and if you want, we can make also separate first Om capital, then Ram capital, then Shanti's capital, but that will unnecessarily take a longer period of time. It is for time management purposes, like that we should have to solve. So this way columnar method we adopted here in case of opening partners capital for all partners capital account. So this is the all partners capital. First buy balance BD, Om capital 3,58,000 we got from old balance sheet. Ram capital 3 lakh we got from old balance sheet. Shanti's capital 2,62,000. Once we can check that here in old balance sheet same figure is there or not. Yes, that is the old balance sheet. Om capital 3,58,000, Ram capital 3 lakh, and Shanti's capital 2,62,000. So same way, the same figure we are considering just buy side. The opening balance sheet is called opening balance of the respective partner, old partner's capital. Now general reserve, that was undistributed profit. Generally it will be distributed to the old partner in their old ratio 3:2:1. The total general reserve here we can see here it is 48,000. That general reserve it was 48,000. That 48,000 we are distributing here among the three partner Om, Ram, and Shanti. Om share 24,000, Ram share 16,000, and Shanti share 8,000. Now a new partner, that is Hanuman, he bring his share of goodwill money. Total agreed value of the goodwill, that is total farm value of the goodwill, it was 3 lakh. Out of that 110, that is 30,000 he brought. So when he brought two entry, one is bank account debit to PGW and PGW account debit to old partners capital. So therefore buy premium for goodwill account. Shortly I wrote here buy premium. So here full term we can write buy premium for goodwill account. According to sacrificing ratio, Om share coming 15,000, Ram share coming 10,000, and Shanti share 5,000. Total 15 plus 10, 25 plus 5, 30,000. Okay. So this side all. Now in this cases revaluation loss arises. So reverse side you have to put the entry to revaluation account. Om share of loss 25,200, Ram 16,800, Shanti 8,400. Once you can check here 25,200, 16,800, 8,400. The same figure we are considering here. Now after that, like here we can balance it, but before the balance, like to find out the new capital of the old partner, once we can check the respective account. So here Om, Ram, and Shanti, their new capital purposes, we will consider their like working. Here is a working note. Their incoming partner, he contributed 1 lakh rupees for 1/10 share. Now if he want to buy entire farm, how much he should have to pay? Now 1 lakh into 10, that is 10 lakh has to pay. Now here out of 10 lakh Hanuman capital 1 lakh, if you minus, that is 9 lakh coming old partners capital. So here that way 9 lakh it is old partners capital. That method we are using, or another method also we can use, that is we can calculate new ratio, and after calculating the new ratio, the out of 10 lakh under new ratio we can distribute to the old partners in their new ratio and to get the new capital. So here in this case is second method we are using. Total capital came 10 lakh, out of that 1 lakh deducted incoming partners. So therefore 10 lakh minus 1 lakh, 9 lakh. So this 9 lakh rupees we can distribute to the old partners in their old ratio. So here it is coming here. Om's capital 9 lakh into 3/6, 4.5 lakhs. Ram capital 9 lakh into 2/6, his share, that is old share, 3 lakh. And Shanti's share 9 lakh into 1/6, 1.5 lakhs. So this is their new capital. So that new capital we are considering here to balance CD 4,50,000, 3 lakh, and 1,50,000. Now afterward we will make the difference which side heavier, and shortest side we can put the current account. This is one way. Another way we can do like this side total addition to balance CD. Again by balance CD means two phase. You can use two phase also in this account. That way also we can do. Which one easy? In this sum we are using this only one phases we can solve here. So first of all, like here we in this system, like we'll compare the debit and credits here. This side, like debit side 4,75,200 coming, whereas credit side is showing less. How much less? 78,200. So we'll put there by current account, that is balancing figure. So this way you can find out the shortage and surplus here. So shortage arises and the shortage transfer by his current account, that is 78,200. Ultimately it is a one type of loan taken by from the firm. He can bring the cash, that time the problem will solve, but here sufficient cash may not be with him, so he want to transfer as per their agreement. Every partner want to transfer their respective current account, so therefore transferring their respective current account. So capital, it is quite high, 4,50,000. So 4,50,000 ultimately not coming here. If you add all these three, his benefit not coming, also loss on revaluation is there. So therefore that either he has to bring this cash 78,200, or we can transfer in his current account in case of home capital. This way we can do, or another way, like in making two phase, like first phase total addition, balance CD, again balance VD, afterward putting that current balance and then difference. So anyway, any method we can adopt. Now second partner, that is RAM capital. Here we can see here RAM capital this side, like credit side here 3 lakhs plus 16 plus 10, 3,26,000, whereas in this side like 3 lakh and 16,800. So this side, like debit side shortage, means his benefit side more. Easily you can withdraw 9,200. So firm has to pay to RAM 9,200 as he want to decrease his capital. Actually his capital is coming more, but as he want to maintain the low capital, so he should get return 9,200 as per agreement. Without returning, they will transfer to the respective current account. So shortest part here we are writing two current account 9,200. In future the RAM can withdraw this amount, that time current account will be cancelled. Now last third partner, that is Shanti. Shanti's this side opening capital 2,62,000, general reserve 8,000, and premium for goodwill, share of goodwill 5,000. It is coming 2,75,000. So his capital benefit side coming 2,75,000, and he want to make 1,50,000. He want to decrease his capital, but here his share of loss is also there. That loss is 8,400 share of loss. So ultimately, if we consider the loss, then also like out of 2,75,000 minus 8,400 minus 1,50,000, this is the balance. This account we are transferring here in his respective current account 1,16,600. He can withdraw the cash, but as per agreement have to transfer the shortage side, that is current account to current account, that is on this column 1,16,600. In near future Shanti can withdraw this amount, but here like Om has to bring this amount in future to cancel their current account. It is one type of loan to the firm, and here in this both the cases the partner given loan to the firm. So this is the opposite character here, so have to remember that. So ultimately we will compare both the side, which side is shortest, there we will put the current account. Simple logic we can apply, and we can compare the partner's capital account. So this way, like it is easy way, we already did this type of problem. It is similar type of problem again and again coming. So this is all about this year problem, that is 2015, I think. So it will be clear to our learner. So this way we can enhance the process. Coming class we will consider 2016, 17, 18, 19, 20, up to 20 we can do here. Let's see. Okay, thank you very much.